everyone. Welcome to the ABFER Annual Conference. I'm Travis Chow from the University of Hong Kong, and I'm the moderator of this session. I would like to welcome everyone to today's accounting session on China-related topics. There are 3 excellent papers in our first accounting session this year. For each paper, the presenter will have 25 minutes to present, followed by a 20-minute discussion by the discussant, and finally, we also have 15 minutes for Q&A. Audience can post their questions using the chat function or the Q&A function in the Zoom. To kickstart our accounting program, we are very delighted to have Professor Emerita Mary Barth from Stanford University as our first presenter. Her paper's title is Information in Mandatory and Voluntary Earnings Announcement Date Forecasts. We are also very glad to have Professor Doug Skinner from Chicago Booth, who is also a senior fellow of the ABFER, to serve as the discussant. Mary, you have 25 minutes. Please take it over.
Thank you, Travis. I just want to thank the ABFER organizers for giving me the opportunity to present our paper. This is, as Travis said, it's Information in Mandatory and Voluntary Earnings Announcement Date Forecast with Greg Clinch and Paul Ma. Even though I miss being in Singapore, I am delighted to be able to present our paper. Paul's in attendance and will be taking notes, and we are looking forward to Doug's discussant remarks and your questions and comments. The question that motivates our research is our mandatory forecasts of earnings announcement dates informative to investors? And do they provide more or less information to investors than voluntary earnings announcement date forecasts? This question leads us to address 2 related research questions. The first is, are mandatory forecasts of earnings announcement dates informative to investors about yet to be announced firm performance? And the second is, what are the informational trade-offs when such forecasts are mandatory versus voluntary? There's a large literature in accounting, finance, and economics that studies the content, quality of various types of forecasts and the motivations of forecasters to create those forecasts. In most cases, these forecasts are voluntary with respect to the act of the forecasting and the timing. Theory suggests that content, act, and timing of voluntary forecasts all could convey information, but there's little empirical evidence on each component of voluntary forecast information or on the information in mandatory forecasts. To provide evidence on mandatory earnings announcement date forecasts, we exploit a requirement in China that all firms simultaneously make public at the end of the quarter a forecast of their upcoming earnings announcement date. Because all China firms have December 31, that means that these forecasts are available at the same time for all firms. We then benchmark the findings regarding information conveyed by these mandatory forecasts against information conveyed by voluntary earnings announcement date forecasts by US firms. So what is the information in earnings announcement date forecasts? US-based studies find that later earnings actual announcement dates are associated with worse firm performance. They also find that forecasts of earnings announcement dates are positively associated with the actual date, and that forecasts of later earnings announcement dates are associated with worse firm performance. China-based studies using data prior to the forecast of earnings announcement dates being publicly available also find that later actual earnings announcement dates are associated with worse firm performance. We confirm this for our sample period. However, we're unaware of any studies assessing the information conveyed by public forecasts of earnings announcement dates in China. This evidence is important because if mandatory earnings announcement date forecasts are not informative, then there's really nothing to be gained by mandating them. So would mandatory forecasts convey information? First, we ask, why wouldn't they? And there are 2 reasons that come to mind. The first is the inability to develop informative forecasts by the mandated forecasting date. As I mentioned, in China, that date is the end of the quarter. And the second is, because the forecasts are mandatory and there's no regulatory penalty for revising them later, a firm could forecast an arbitrary or strategically selected date, such as the last day of the reporting window, which would convey no information. But why would they be informative? And I guess the main thing we're thinking about is that managers' career concerns, such as cultivating a reputation for timeliness and accuracy, would motivate them to issue accurate forecasts. Why can't we just infer this inference from evidence on voluntary forecasts? As we all know, voluntary forecast results from self-selection in response to a whole variety of incentives. And that means that the findings from voluntary forecasts don't necessarily apply to mandatory forecasts. In China, as in the US, firms report quarterly earnings within a specified reporting window. China firms are not required to announce earnings per se, but are required to release publicly their quarterly financial report. We refer to this as announcing earnings because the financial reports includes earnings, and this is the first time the firm issues those earnings numbers. In China, unlike in the US, firms must schedule with the stock exchange their upcoming earnings announcement date. Since 2002, this date forecast is public. As I said before, China firms can update the forecast, but they're not permitted to announce earnings without advance notice to the market of at least 1 day. In the US, firms voluntary forecast earnings announcement dates, and the timing of the forecast is also voluntary. During our sample period, 51% of US firms do not issue these forecasts. 29% of them issue forecasts in some but not all quarters, and 20% issue them every quarter. We refer to these firms as the never, sometimes, and always forecasters. Regarding timing, US firms that issue forecasts do so about 1/3 into the reporting window, whereas, as I said, China firms do them at the beginning of the reporting window. So the information, whatever information there is, comes earlier in China than in the US. For firms with a March 31st or year end, I just want to go through the timeline. Sometime before the end of the reporting window, the required date, the firm announces earnings. In China, on March 31st, or give or take a day or two, the forecast they make of their earnings announcement date is publicly available. And again, all firms simultaneously, because the exchange releases the calendar with all of the dates listed. As I said, China firms can revise these forecasts at various times as they need to, because they are not allowed to release earnings without rescheduling their announcement. The US firms, on the other hand, forecast anytime within the reporting window up before the earnings announcement. And some firms do it and some firms don't. The reporting window varies by quarter. In China, 30 days, 60 days, 30 days, and 120 for quarters 1, 2, 3, and 4. The US is 45, 45, 45, and then 90. So in our empirical test, we scale each of these date measures by the length of the reporting window. So you should think of all of our variables as the percentage of the reporting window during which these events happen. Regarding the sample and data, we focus on China firms trading A shares in the Shenzhen and Shanghai stock exchanges. We have actual and forecast earnings announcement dates from the second quarter of 2004 to the third quarter of 2013, and forecast revisions from 2010 quarter 4. For China firms, we hand collected these forecasts daily from the Shenzhen and Shanghai stock exchange website. For US firms, we get the EA earnings announcement date forecast from Capital IQ. The other variables come from the standard sources. And our final sample has 44,489 firm quarter observations from 2,464 China firms. And for the US forecasting firms, so this is the always and sometimes forecasters, we have 76,863 firm quarter observations from 3,600 US forecasting firms. To preview the result and to give you an idea where we're going, because there are a lot of results, we find that with respect to the first question as to whether mandatory forecasts of earnings announcement dates are informative to investors about yet to be announced firm performance, we find that the answer is yes. Mandatory forecasts are predictive of actual earnings announcement dates. Forecasts of later and later than expected earnings announcement dates predict lower yet to be announced firm performance. And the market reacts negatively to forecasts of earnings announcement dates later than expected. What are the trade-offs for mandatory and voluntary forecasts? Well, this is a bit more nuanced. Mandatory and voluntary forecasts, it turns out, we find, both convey about 8% of the quarter's earnings news. And I have to tell you that we were a bit surprised by that. Untabulated statistics revealed that the differences, as you'll see later, are not significant. Regarding mandatory forecasts, we also find that forecasts issued by China firms that are less likely to forecast voluntarily, if forecasting were voluntarily, and I'll explain how we come to that later, are informative. And regarding voluntary forecasts, we find that the content, act, and timing each reflects incremental performance information, but only content reflects incremental in earnings news to the market. Okay, now for the data, for the results. We start with the descriptive statistics. F is the forecasted date, and X is an actual announcement date. You see for China firms, the initially forecasted earnings announcement date is 76.7% into the reporting window. The actual date is somewhat later, 77.1%. Again, they make this forecast at date 0 of the forecasting window. The reporting window. For US firms on average, the forecasted date is 65.3% of the window, and actual date is also later, but closer than China, 65.5%. X post minus X pre is the estimate of investors' revision to the expected earnings announcement date upon seeing the forecast. As indicated at the bottom of the slide, X pre is the expectation before seeing the forecast, based only on the actual earnings announcement date for the same fiscal quarter in the prior year. And X post is a revised date after seeing the forecast, so it depends on the forecast as well. The 3 performance measures that are available to us to use are 2 indicators. One is an indicator for whether the firm ultimately reports negative earnings per share, and another indicator for whether the earnings per share is a negative change from the same fiscal quarter from the prior year. And we also look at ROA, net income divided by end of quarter total assets. Panel A of this table confirms a finding in prior China research that later actual earnings announcement dates are associated with worse firm performance. Incrementally, all 3 performance measures are significantly negative, and the p-value is 0.000. Panel B shows that in China, later mandatory forecasted dates are also associated with worse firm performance. Again, all 3 incrementally, and the p-value of the 3 of them together is 0.000. Together, these findings establish that mandatory forecast of earnings announcement dates can reveal information to investors because they reflect yet to be announced firm performance. Panel A of this table shows that the forecasted date is significant in predicting the actual date, incremental to the prior actual date. Panel B shows that the revision to the expected earnings announcement date upon seeing the forecast, this X post minus X pre, reflects information about yet to be announced firm performance for all 3 performance measures. Panel C shows that at the time of the forecast, so this is again at quarter end, at the time of the forecast, when the forecast is issued, the market reacts accordingly. That is a negative reaction the later the updated forecast date is. The second column also reflects market reaction in the right sign, but it's still a delayed reaction. And it turns out that this delayed reaction is consistent with reaction based on US firms in prior research. The posting date generally occurs, as I said, no more than a few days before, no more than 1 day after quarter end. It varies somewhat quarter to quarter, so we estimate all of our results with a little bit wider window, and the inferences are the same. Together, these findings reveal that mandatory forecasts of earnings announcement dates are informative to investors about yet to be announced firm performance. This table follows the Ball and Shiva Kumar approach to determine how much of the quarter's earnings news is conveyed by the earnings announcement date forecast. Panel A shows how much the earnings news shows the relation between the earnings news and the 4 different time windows. The first is the quarter, the 60 days, 62 days that begin 1 day before the end of the quarter and extend 60 days beyond. The second is the date right at the end of the quarter when the forecast is issued, forecast of the earnings announcement date is issued. X is the earnings announcement date, and then we benchmark it against a random date, random 3-day window. The key for us is this ERC ratio, which shows that 8% of the news that comes out after day -1 about earnings is reflected in the forecast announcement. That's for mandatory forecasts in China. And panel B gives you analogous statistics for voluntary forecasts in the US. And again, the key is the ERC ratio here is 8.8%. These two numbers to us were strikingly similar. And as I said, they are statistically insignificantly different from each other. To provide evidence on the information gained by mandatory earnings announcement date forecasts, we would really like to know which China firms would not forecast the earnings announcement date if they were not required to do so. Because any information conveyed by these firms' earnings announcement date forecasts is gained by making it mandatory as opposed to voluntary. Unfortunately, we don't observe those firms. Thus, instead, we focus on 3 firm characteristics that disclosure theory suggests should help us identify these firms. The paper offers a basic model of information available to firms and investors, and then for each firm, we estimate the precisions of private and public information and actual earnings announcement date persistence. To externally validate our identifying characteristics, we estimate them for each US firm and show they're significant in explaining US firms' forecasting choices. This table presents the finding. Panel A shows that all 3 parameters are significantly different as predicted for US firms that never, sometimes, and always forecast their earnings announcement dates. Panel B shows that the correlations are positive between the 3 parameters, but not perfectly correlated. And panel C shows that the private information provision and public information precision are incrementally informative to each other and to earnings announcement date persistent in explaining US forecasting frequency. So we use these findings to provide support for our use of these firm characteristics to identify would-be voluntary forecasting China firms. This table presents the result for the China firms, partitioned on whether they have a low or high probability of forecasting if forecasting were voluntary, using the information characteristics that I just talked about. We identify a China firm as having a low probability of forecasting if the sum of its tercile memberships of private and public information precisions and announcement date persistence is 3 to 5, and a high probability if it's 6 to 9. Tercile membership equals 1 in the lowest decile and tercile and 3 in the highest. Untabulated findings, by the way, reveal that if we partition the firm on membership in the lowest and highest tercile of each forecasting information characteristic separately, doesn't change the inferences. So it's not a matter of how we partition these. These are all significantly different. Panel A shows that they are significantly different in the expected direction. Although we partition the firms on these characteristics, there's really no guarantee that any, let alone all 3 of the differences would be significant. Panel B reveals no evidence that the earnings announcement date forecasts of low probability China firms reflect less earnings news than those of high probability firms. That is, the ERC ratio that I talked about a minute ago is statistically not different from each other for the high and the low probability forecasting firms. Panel C of this table shows that the findings for later earnings announcement dates, later forecasted earnings announcement dates, and later updated expectations of earnings announcement dates are associated with worst yet to be announced firm performance. That finding applies to both high and low forecasting probability firms. And panel D shows that the significant immediate market reaction to the earnings announcement date forecast that I talked about in table 3 largely is attributable to forecast by the low probability firms, whereas a delayed reaction is attributable to both groups. So I think taken together, we interpret table 7 as revealing that mandatory earnings announcement date forecasts provide information about yet to be announced performance, even by firms less likely to forecast voluntarily. These findings reveal the information we've gained when forecasting is mandatory. The last table provides evidence on the extent to which the information conveyed by voluntary earnings announcement date forecasts associated with the act, content, and timing of the forecast for voluntary forecasts. Panel A shows that the act, content, and timing of voluntary forecasts each reflects information about yet to be announced firm performance incremental to the others. So at least one performance measure is significant in the predicted direction for each of these characteristics. Panel B shows that the market reacts to the information in the forecast relating to all three forecast aspects, but the reaction to the timing of the forecast is delayed, as it was before. However, panel C shows that incremental to the content of the forecast, the act and timing of voluntary earnings announcement forecasts do not convey significant earnings news. So taken together, Table 8 reveals that the act and timing of voluntary forecasts are not informative to investors about upcoming earnings, which suggests that little information is lost when these two information sources are eliminated by mandatory forecasting. So in conclusion, we find similar percentages of the quarter's earnings news is conveyed by mandatory China and voluntary US earnings announcement date forecasts. Mandatory China earnings announcement date forecasts provide information about yet to be announced firm performance and convey earnings news, despite making the forecast at the beginning of the reporting window, when you might think it might be more difficult to do, even for firms less likely to forecast if forecasting were voluntary. And the market reacts to information in the initial and revised mandatory forecast. I didn't give you the table on revised forecast revisions because in the interest of time, but they're consistent with the initial forecast. Only 14% of the initial forecasts are revised, by the way. Voluntary earnings U.S. earnings announcement date forecasts provide information primarily through the forecasted announcement date. The act of forecasting and forecast timing provides some information, but not significant incremental earnings news. However, as I said in the outset, 51% of US firms do not issue these forecasts, so that the information associated with their earnings announcement date forecast is zero because they don't do it. So taken together, we think that the study shows that mandatory earnings announcement date forecasts for all firms in aggregate can provide more and earlier information to investors than voluntary forecasts. Thank you very much, and I look forward to Doug's comments.
Thank you, Mary. Up next, we have Professor Doug Skinner to discuss the paper.
Well, thank you, everyone. I very much appreciate the opportunity here. And on behalf of the organizers of the conference, would like to welcome all of you to Singapore. As you can see in the background here, I'm actually at the Shangri-La Hotel here on Sentosa Island. I arrived here a couple days ago, and to my surprise, no one else is here. So I decided to go ahead anyway, and we'll welcome you to the conference. Let me go ahead here and share my screen and then discuss this most interesting paper. Okay, can everyone see my screen? Okay, great. I think by now we're all very familiar with this way of presenting, and of course we look forward to a time, hopefully not too far distant, when we can all gather in person again. So as I mentioned, I think this is a really interesting paper, and what I try to focus on in my remarks here, in addition to discussing the paper itself, is really trying to put the paper in the context of the literature in this area, which I have found for many years, going back to when I was in the PhD program at Rochester, to be a super interesting area. And I remember reading, I think, a paper by Chambers and Penman, which is published in JAR in 1984, which has to do with this phenomenon. And it's been a lot of interesting research on this since that time. So let me jump in here. One of the things, or one of the impressions I get from reading the paper, and I mean, we saw this in what Mary presented, is that what the authors are really trying to do is connect the setting in China against the findings that we have from US data here. And in some ways, and perhaps this reflects the author's experience to this point in the refereeing process and the editing process. But in some ways, the authors work very hard, perhaps even too hard, to make the two settings comparable and to connect them. Now, ultimately, I think they're successful, but one of the things I think is really interesting about the questions that are still open in this area, as well as the setting in China, which Mary talked about a little bit, and I'll talk about some more as well, is that, I think embracing the differences in really looking at how this Chinese setting is different could really actually help the authors develop some different types of answers to the questions that are floating around here. So let me try and explain what I mean by that. Okay, so one of the challenges the authors have here is that there's a lot of complexity here. So I guess one thing I wanted to start out with is just to make sure everyone's clear about what the events are here. And there's basically two events that are going on. One is the initial scheduling announcement. And I'm going to use this terminology, scheduling announcement, because I find this term forecasting the announcement day confusing, because I spent, I think, a couple hours reading the paper before I realized they were talking about scheduling or forecasting the dates as opposed to the earnings themselves. So let me use this terminology, scheduling. So the first thing that happens is that in China, just after the fiscal quarter end, there is an initial scheduling announcement in which the company announces when it's subsequently going to announce earnings. So one of the questions is that scheduling announcement informative? And as Mary conveyed, the authors find, consistent with previous research, that scheduling announcement is informative in its own right. And then secondly, as the reporting period, as Mary calls it, moves forward and we get closer to the earnings announcement date, in the China setting, you could have a rescheduling. So they could change the scheduled date. Or in the absence of rescheduling, you could actually have a surprise with respect to the earnings date timing itself. So later in the quarter or later in the announcement window, you can get a surprise as to timing a second time. And that turns out to be informative as well. And as I think Mary conveyed, very consistent with previous research, it seems to be the case that later, further out announcements are associated with negative news. And that phenomenon seems to be pervasive in this literature, including in Mary's work. And so the authors argue that this earnings announcement date scheduling conveys news, and as Mary indicated and summarized there, they find that the scheduling of earnings announcements is informative, and more specifically, they find that these announcements convey around 8% of the total earnings news for the period, which is very similar to the finding in the voluntary regime in the US. So in some ways, that is kind of the most interesting result, I think, based on their interpretation. And I think I agree with them, that's interesting in the sense that if we think about the regime in the US where you have voluntary scheduling of these dates, perhaps it's not surprising that if you self-select to forecast or schedule these dates in advance, there's going to be some information in that to the extent, let's say, of 8% of the total earnings dues. It's not at all obvious that you would get that same result in a mandatory regime. So the fact that they find an approximately 8% number as well for this mandatory setting in China is actually something of a remarkable finding. And so let me talk about some of my observations about this. One of the things that I find interesting or curious about this setting is if we're thinking about what's going on here, why is this informative? And you think, well, one of the reasons it's informative might be because, well, managers want to use this forecasting or scheduling mechanism to tell us what the earnings news, something about what the earnings news is going to be. Now, what's surprising about that is managers could actually forecast or pre-announce the earnings themselves. So one thing that I'd really like to know is, why is it that managers, perhaps this is a mandatory phenomenon, but there's information in this initial scheduling of the earnings dates, but presumably managers could actually pre-announce the earnings themselves. And it's not entirely clear to me whether managers can do that in China, whether that's something that they could do on a supplementary basis, whether they can't do that in China, and that's why this scheduling announcement is relatively important. So understanding how this relates to what I think about in terms of the pre-disclosure of the news itself is something that I think is really interesting. Now, one thing that I wanted to do is just show you, this is, as you see, from Starbucks. So what happens in the US is a firm like Starbucks, in this case, on January 12 this year, they made one of these scheduling announcements, and they announced on January 12th, which was a Tuesday, that they would announce their earnings for, I think, their fiscal first quarter on January 26th. So they announced 2 weeks ahead that they were going to announce earnings on January 26th. And so this is the type of voluntary announcement that they're talking about for US firms. And as Mary indicated, interestingly, in the US, about half of firms don't make this type of scheduling announcement. There's another 30% approximately who sometimes make this announcement. And then there's only a fifth of firms that do this every quarter. So as I mentioned, advanced scheduling is voluntary in the US. The reason I'm pointing this out is because this time frame is relatively short. It's about 2 weeks. And I'll come back to that. So let me talk at a high level about the questions that are floating around in this literature. As I mentioned, and as Mary's paper cites, and if you look, there's a Johnson and So paper that addresses this in the US. It's probably the most up-to-date US data on this. And then there's also a DeHaan, Shevlin, and Thornock paper, which has to do with intraday timing. But if you look at several papers that did this in the 1980s, essentially what they looked at was whether, when firms announced earnings earlier or later than expected, was there any information content in just the timing, apart from the earnings news itself? And that's when we first found this sort of curious evidence that if earnings news or earnings announcements were delayed, it represented negative news about the company. And if the company announced earlier than expected, it tended to be more positive news than negative news. So we got this relation between the earnings announcement date timing and the underlying news itself. Now, one of the tricky features of that early literature was it's difficult to know what the expected earnings announcement date is. And so you have to just, in the early research, and the authors do this to some degree in the paper itself here, is you basically have to look at what happened last year. And it turns out that if you looked for Starbucks, in my example, in the January announcement I mentioned, they announced on the 4th Tuesday in January this year, meaning 2021. They did the same thing last year in 2020. But if you go back to 2019, they announced on a Thursday. So these patterns are not entirely predictable. And of course, if you're Starbucks, the company is telling you 2 weeks in advance what happened. So one of the things we still don't know, I don't think here, and one of the things that I think I'd like the authors to try and probe a little bit about is what the mechanism is. So they find some results here in terms of these announcements being informative, both types of announcements being informative, but we don't really know why. And the 4 bullet points you see at the top there are potential explanations that float around in the literature, but I think these are still open questions that we don't really know exactly why this is, especially why is it that managers tend to delay the announcement when the news tends to be negative or bad news. And as I mentioned, the interesting thing in the US is that you tell the market only 2 weeks before the announcement when the announcement is going to take place. So at that point, it's possible that you're still in the process of figuring things out. But the difference in the Chinese setting, if I understand the data right in Mary's paper, is this time frame is a lot longer between the initial scheduling announcement and when earnings are ultimately announced, especially for the 6-monthly or the annual numbers. So it's a little less clear in the Chinese setting why the timing of these dates are going to be informative. The other interesting economic feature of the environment here is that is this question that managers in some of this work, managers are hypothesized to strategically time disclosure in low attention periods. So maybe what's going on is that managers, when they have bad news, are trying to disclose that news at a point in time when the market is not paying attention. So they may be doing this after hours, they may be doing this on Fridays, they may be doing this on Friday after hours when everyone's gone home for the weekend. And so that clearly is something of a market inefficiency story. And as Mary alluded to in her paper, the market doesn't seem to fully figure this out. In other words, the market doesn't seem to fully process the fact that there's information in the scheduling of these announcements, and that tells you something about the news. So you get these phenomena like drifts. So here are some of the interesting features of the Chinese setting, right? One of the differences, which I already mentioned, is that, as Mary indicated, in the Chinese setting, as I understand it, you have to schedule very quickly right after the end of the fiscal period, but then the period you have to actually report earnings varies depending on which fiscal quarter you're in. And the difference vis-a-vis the US data is that these windows are quite a lot longer in some instances than in the US, which makes it even more interesting that these scheduling announcements are so informative or are informative at all, in fact. Now, the other interesting thing that's in one of the footnotes in the paper that I think the authors may want to exploit a little more is just the fact that you've got these different regimes. And if we're interested in this interesting idea from Hirschleifer, Lim, and Teo, for example, that somehow if a lot of companies announce on a single date, there's limited attention, and then the information in those earnings announcements doesn't get fully processed by investors, and investors don't fully respond. I think the authors actually have a nice setting, given the regime shifts from 98 to 2002 to 2012, to actually figure some of this out. The other interesting result that's floating around here in the background is this result that there's positive returns on earnings announcement date unconditionally. So there's a paper by Cohen, Day, Leese, and Sonder in JA 2007 that tries to look at this earnings announcement date timing phenomenon and explain this premia to earnings announcements. So, you know, the point I'm making here is that I think there's some really interesting features of this institutional setting, that in the current paper or maybe a different paper, the authors could exploit, especially this fact that if you think about earnings announcement periods, you can have a lot of firms announcing on a single day. And if you believe there's any type of crowding out of information and inattention or any of those things going on, it seems like this Chinese setting where, first of all, they had the scheduling, then they had limits in the number of firms in each day, and then they removed the limits, would be something that could be exploited to try and better understand some of these things. Now, one thing in the paper that Mary talked about, and that's actually quite critical for the authors, is to try and divide the Chinese firms into what I would call quasi or pseudo voluntary firms and mandatory firms. And so they have this prediction model to try and do that. And they're ultimately what they find, as Mary indicated, is there's no difference if you split the Chinese firms in this way. Now, that could be consistent with what the authors are interpreting it as, or it could just mean that their model for separating the firms into the two buckets is not all that powerful. One thing that I'd like to understand a little more is actually this model of how they tried to figure out which firms would voluntarily forecast and which firms would not. And this brings me to a question about both the Johnson and So paper, which does this in the US recently, and the BLM paper, so this paper, don't really tell us much about what's going on with these US firms. Why are some US firms doing this and others are not? Right now, and this sort of tells you, this is an interesting question in its own right. And if you go back to my Starbucks example, why would firms actually do this scheduling at all in the US? Well, it seems like it makes sense if you've got a lot of analysts following, and those analysts need to schedule when they're going to be sitting on conference calls and when they're going to be talking to management and when they're going to be writing the reports, because analysts spend a lot of time writing reports and listening to earnings calls on the day earnings are announced for large companies like Starbucks. So it makes sense those firms would schedule, because the analysts need to schedule their time such that they can actually meaningfully make these coverages. But I think understanding more about that, I mean, I would think this is similar to other types of voluntary disclosures, like earnings guidance, for example. So maybe it's the really large firms with high analyst following, high evaluations, and so on, are the ones that are actually doing this voluntary scheduling. But I think there's kind of a bunch of stuff to dig into there. So let me conclude by saying, overall, I think this is an interesting paper. I think it is quite remarkable, as Mary observed, that we're getting this finding that this scheduling announcement, so just scheduling the earnings announcement, explains around 8% of the total amount of earnings news conveyed during each quarter. So without actually telling you anything about earnings directly, the timing is telling you something, 8% of the total news, which, as I said, is quite remarkable. Now, what I'd really like to know and don't fully understand is why exactly this happens. How does this information get out? Is this something unconscious in the scheduling? Is this something that managers of these firms are consciously doing? And if so, if they're consciously trying to provide information about earnings, couldn't they just provide us with a pre-disclosure of the earnings themselves, similar to what we see many US firms doing? So there's some things I think that the authors could do here. But as I also mentioned, there's some interesting open questions in this whole area. We don't really understand fully why delayed earnings announcement dates are actually associated with negative news and adverse performance. it seems possible that this phenomenon may explain this puzzling earnings announcement date premium. And it seems possible that this Chinese setting would actually allow us to find out a little more about this investor inattention area. So I think there's a lot more work to do there. And so let me stop and hope that those comments were informative. Thank you.
Thank you, Doug, for the very detailed discussion. Before we open the floor for Q&A, Mary, would you like to take some time to respond to Doug's discussion?
I just want to thank Doug for those great comments. There is a lot going on here. You're absolutely correct. We find a lot of this stuff fascinating too. It's hard to figure out what's going on and why. As I told you, we were surprised at some of these results. And I think if you're willing to share your slides, we would appreciate it, because there are a lot of questions and we have to figure out, we have a lot of stuff. We have to figure out the most interesting stuff and how to actually get at it. I think you gave us a lot of food for thought. It'd be easier for us if you gave us one question and we said, that's the one that's really important. We'll go do it. But we thank you very, very much. So I just want to say I appreciate that, and I'm happy to open the floor to questions.
Mary, can I ask a question?
Sure.
Okay. Oh, I let me turn on my.
Ben, I was trying to figure out. I was looking for where the yellow box was and trying to see who was asking this question.
Yeah. I forgot to turn on the video. Yeah. So yeah, I actually, as Doug said, actually I was a little bit confused initially by your presentation because I missed the one keyword in your definition, which is the earnings announcement day forecast. So when I read the paper, sometimes you call earnings forecast. Sometimes like the title says the earnings announcement day forecast, but somehow I missed the day. So maybe it's just a suggestion. Maybe it's a useful kind of if you could use the name consistently, because we do have another kind of stream of literature where researchers are examining earnings forecasts in the Chinese setting as well. So as a result of that, that could be useful to avoid confusion. Now my question is, because kind of you are focusing on the earnings announcement day forecast, but on the other hand, Chinese firms are also required in many situations to issue mandatory earnings forecasts around maybe the same time. So I just wonder if your results are somehow confounded by some of those kind of events.
So let me just say I appreciate the comment. Apparently, Doug was confused by the terminology. I think we're so used to think about forecasts as being earnings forecasts that if you don't say it 16 times, every single time, date, people get lapsed back into that. Then it gets very hard to read. So maybe Doug's right. Maybe we should just abandon that language, because I remember years ago when people talk about management forecasts, I kept saying, of what? Of what? Management forecasts of what? But everybody just knows it to be earnings. So anyways, we take that point, and we don't want people to be confused. It's hard. The paper's hard enough to follow as it is, to let alone be confused. But with respect to earnings forecasts, this is something we're actually finally have some data on. So this will help us maybe get to some of the things that Doug was talking about too. What we did in the paper is we looked at the requirements for these mandatory forecasts, and then we said, let's drop the firms from our tests that it looks like they would be required. In China, they're required to issue an earnings forecast if I can't remember the exact details right now, but if they have negative news, or they're going to have a decrease in earnings of more than 50% over the prior year or something like that, they must issue an earnings forecast. So we looked at the requirements and dropped those from the sample, and it didn't really have any effect on the inference we have. Now we've since gotten earnings forecasts, and it turns out that some Chinese firms actually have voluntary earnings forecasts, as well as the mandatory ones. But what concerned us the most, until Doug raised some of these other bigger picture questions, but what concerned us the most about the paper was how many of those are happening in the within this -1 to 1 date that around which we're measuring the reaction to the date forecast. And the answer is virtually none. We've just come up with that data in the last week or so. They are out there, but in that window, there's a peak before like a couple weeks and a little bit earlier before the quarter end, and then again afterwards. But right around earnings, and I think the number is less. It's less than 1% of our observations have earnings forecasts, management earnings forecast in that window. So that is something where we have some data we're going to try to look at. If you've got some ideas on the interesting parts to look at, please let me know, and I'll.
Yeah, that's good to know. Yeah. Okay. Thank you.
Yep.
Do you have any other questions from the audience?
Well, if there's no question, maybe I could just comment on one thing that Doug talked about. Interesting about this crowding out and inattention. It's hard to figure out why the Chinese regulators do the things they do, because they don't. There are not a lot of public documents that explain it all. And as you said, there's been regime change. We're trying to figure some of this stuff out, but it seems pretty clear that one of the things they were concerned about with this scheduling, I'll call it scheduling, is the fact that a lot of firms that were announcing earnings on the same day, and they wanted investors to be able to pay attention when the earnings were announced. And that's why they required everybody to schedule the date so investors knew. And then, as you mentioned on your slide, and it was in the paper, they put quotas on some of these days and said, we're not going to allow more than 10 firms, 20 firms, 30 firms, whatever it was at the particular point in time, to announce on that day. And if that date's already full, I'm sorry, you have to pick another day. And so we've done a little bit of playing around in the paper. You may have noticed with the extent to which these earnings announcement date forecast happened. We're announcing earnings on clustered days. We call them, I can't remember what we call them now. Limit days, where they're on limit days. We assume those are the most informative because the firms got the date they really wanted. So to the extent they're trying to convey information, or it does convey information on the limit days, that should be the strongest. The days around the limit days are probably the weakest because they got pushed one way or the other. They're near where they want to be, but not right at it. And then other firms that have just kind of at different times in the reporting window. So that we do a little playing around with that. But the reason that they wanted to do this in the first place, I think, was to make sure that the market had advance notice of everyone's earnings. Sorry for a long answer there. It looks like I
was just going to say, the fact that the Chinese regulators apparently were concerned about this same inattention type of, like this crowding out notion, right, is interesting, I think, in its own right. So I mean, and I was just curious about what the firm's strategy is. If you have good news, if you know you have good news for the period, do you try and schedule the very first date you could, so that the ones who are scheduling later on are kind of the ones who are lazy, or they didn't get around to it in time? Or, I mean, there's lots of interesting things to do there. So like I said, I think poking around in that a little bit and thinking about what you could do would be super interesting.
Thank you.
Looks like there's another hand.
Hand up, yep. Wenji?
Hi, I have a question. I'm just wondering if this change of schedule would affect the attendance of the analysts for the conference call, because if I do not want someone to attend my meeting, then I just change the schedule, surprisingly, right? So I think that could be the mechanism of people not paying attention to the announcement after the change of the schedule, something like that.
I think that's right, but I think that's more likely to happen in the U.S. because, as I said, in China, they have to reschedule. They're not allowed to announce earnings without giving the market advance notice that they're going to do it. So there can't be a surprise earnings announcement. They have to at least give the market a day, a day's notice before they do it. So, but that's a good question, though.
Yeah, given that people are busy, right? They already have their schedule planned 1 month ahead of time. So if they reschedule, it's highly likely that some people would not be able to attend the meeting.
Yeah.
that perhaps, but perhaps you don't have the data on the attendance of the meeting.
Yeah, I mean, to be honest with you, I don't know. I'd have to look into the extent to which conference calls are as big a deal in China as they are in the US. That's something about the difference in the settings that I don't really know. I mean, we know they're very, very important in the US, but I don't know the extent to which the same is true in China. Maybe it is, but that's something to think about. So thank you very much.
Yeah, that's just my random thought. Thank you.
So Mary, another follow-up question. So your setting starts from 2012. So you don't have the scheduled earnings announcement date before that particular time?
We started, well, this is the royal we, because my name is on the paper, but it's really Paul. Paul discovered this and started taking daily screenshots, screen captures of the exchange's website, because they don't actually announce the scheduling. They post a calendar, and that's all you get to see. And if the calendar changes, you can see that if you go back a week later, you find out it was changed, but unless you get the screenshot every day, you don't know when it was changed. So there's not that much. So yes, that's right. That's when Paul started taking screenshots of the exchange's websites to figure out when these schedules when these firms were doing the scheduling.
But my understanding is maybe Paul should check because there could be some databases which could have already captured such kind of information for researchers.
Yeah, I think, yeah, if you know something, please let us know. We've been trying to get as much information out. I actually asked my former colleague, Zhang Weibo from the ISB, because he used to be the, I don't know what they call him, but like the head of the Chinese security regulator.
Yes.
And I said, please help us. We're trying to figure out what's going on over there and what data we can get. And he was very kind. You'll see if you read the paper, there's a footnote that says this whole section of the paper, was facilitated. Our knowledge of this was all facilitated by him. He allowed us to write questions, had to be written in Chinese, and he gave them to the heads of the exchanges to get answers for us on some of these questions. But we kept asking about data, and it's not forthcoming. But we'll give it another try if you think there's something there.
Because the data must be retained by the stock exchanges, not by the CSRC. The regulator, the Chinese SEC, right?
Yeah, no, the two people who answered our questions were the head of the two exchanges.
Oh, okay.
But anyways, we've been trying. So if you have ideas on how to get data, or you think there's something out there we should ask for specifically, maybe we can come up with it. But we've been trying.
I will let you know through email. Yeah, if
thank you.
Have that.
Thank you very much.
Okay.
I appreciate that very much.
We have a couple of minutes left. Maybe I ask one brief question, Mary. Because when I first read your paper, I find it very interesting in the sense that you start out right from doing a comparison between this interesting Chinese setting to a group of US firms. So when you are starting the paper in your mind, to what extent you decided to do it right away instead of, say, you focus on the China setting for the whole paper and then probably discuss some similarity or generalizability issues towards the end of the paper?
So you asked me when we made that decision? Is that
when you made the decision.
It was pretty early on because when Greg and I found out what Paul knew, that this feature existed in China where there were mandatory forecasts scheduling something in the future. And the question was, we don't have mandatory forecasts of very many things. Doug wrote a nice paper on a mandatory earnings forecast in Japan, but I think you have to find particular settings where you have mandatory forecasting, scheduling, giving some information out, you're required to do it. And when we found that out, then it was like coming from a US setting, I thought, wow, now we have mandatory and voluntary, and it would be really interesting to try to figure out what we can learn from each. And I didn't know what the results were going to be. I had no idea. When Doug said we worked hard to make them look the same, we worked hard. Yes, I get that part. But not to necessarily, we were surprised when they came out as similar as they did. But I think it was early on, Travis, because it was in a unique setting, but what really piqued my interest, I have to admit, is the fact that it was quite different from what we see in the US. And the big difference is the mandatory versus voluntary.
That's great. Do you have any other from the audience? If not, then we can conclude this section. I would like to thank you, Mary, for presenting such an interesting paper, and Doug for the very insightful discussion. We have a 15 minutes break. Please come back at 9:45 for the next session.
Thank you very much. Thanks again, Doug.